I never go into a year or go look forward with the expectation that we're going to have more favorable interest rates. I just assume that what we're dealing with now is the norm, that we might see some increases relative to this new norm. And if we go the other way, where we get some reduction in rates, that quite frankly is just gravy and upside.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec and really in all over of Canada. And today I'm very proud and honored to have a man that I look up to, and I look forward to interviewing again. It's not his first time on the show. I'd like to welcome Christian Szpilfogel to the episode. Hi, Christian.
Hey, thank you very much for having me again, Axel. It's always a pleasure.
It is. And so we saw each other a few weeks ago in Ottawa, and then we ended up having a long phone call after that. And I was like, Christian, I always enjoy talking to you. Please come back on the show so other people can benefit from your real estate investment wisdom. So here you are.
I don't know how wise I am, but I have a bit of experience for sure. And it's always a pleasure talking with you, right? Especially getting a really good view on what's happening in Quebec development in particular.
Yeah, it's fun. So, all right, before we dive into it, just thank you for all of our listeners. Thank you for sharing this episode with a friend who could benefit from this conversation. Christian has a lot of experience, as he said, and it's always good to learn from wisdom, from more experience. So leave us a review, send us some comments, some questions. We are in the process of organizing all of the next few months of the year. So if you have any topics you'd like to hear about, let me know and we'll find some experts to answer your questions. So Christian, I usually start with how in the world did you get started in real estate investing, but we already know that. Now, just before we started, we're just chatting about everything that's happened in 2023. We're now beginning at 2024 and just kind of wanted to ask, like, given this new economic environment, how are you choosing the deals that you even consider and look at? What are you looking for?
Right. So I'm going to start with the fact that my underwriting practices don't really change. I have a discipline that requires me, to make sure that any acquisition that I have is going to cash flow either on acquisition or I have line of sight to cash flow after I complete a project or a business case. And then the second priority I have is finding a way to extract additional and new working capital out of this new project. So I'm constantly expanding my working capital pool. So I've always taken that approach. In the current conditions, in the current situation, the underwriting principles stay the same. However, the opportunities are more plentiful. I'm sure you're finding this too. I just don't have as much competition on a deal anymore. And the only thing that I find more challenging right now is managing sellers' expectations in terms of what their pricing needs to be in the current environment. So it's a very natural thing, especially in the commercial real estate space, that when interest rates go up, the cap rates come down, the cap rates go up as well. So, right, but the value of the building goes down as a result. So for me, I've actually been finding lots of opportunities. I've got actually increased deal flow right now with, two things. One, sellers that are really more motivated. The other is real estate brokers that are also motivated right now because they're a bit more hungry. So they're literally going and beating the bushes and bringing opportunities to me.
Yeah.
I think in the last 24 hours, I've been presented with 4 or 5 rather interesting opportunities. So the issue is how do you weed those out and focus on what's really important. So I've actually been buying in this environment.
Brokers come to those who close, and you've been known to close, so they send you more deals.
That's true, and I'm clear about it too. So I don't waste anybody's time. If I'm looking at an opportunity and I don't think I'm going to do anything with it, I'll tell them straight out. So I don't waste
Exactly.
their time, and
Yeah.
they just move on.
Mhm.
And you're quite right. I mean, brokers really just want to deal with people who are serious and that are actually going to close. If they get a feel that you're a tire kicker, you've lost them pretty much forever. And that's where I see a lot of education courses going on right now, is just put in an offer, just put in an offer, and just go see it. And you see people taking pictures with themselves in front of a bank of electrical power meters and stuff like that. And, seeing posts that say, under contract, or I'm visiting the site, and you never see them say, I've got it,
I closed.
or I've got it closed, let alone a firm offer.
Yeah.
So, and realtors pick up on that really fast, and they know what's a tire kicker and who's serious. So if you really want good quality leads, and Axel, you're a very reputable person, and I'm sure this is exactly the way you work. But for people listening, if you want reputable or want leads coming into you, right, then you have to develop a reputation for, as you said, being very serious about what you do, demonstrating that you understand how a deal works, and doing proper underwriting practices, and quite frankly, closing on opportunities. So if a realtor brings it to you and you're serious and you're doing your due diligence, the way I approach it is, if I'm going to the point of due diligence, then my intent is to close, right? Not to do a discovery and a fishing exercise. It's really very much about, I plan to close unless the due diligence shows me there's something that's materially wrong. And if I do find something that's material, I'll go back to the seller and say, you're going to need to rectify this, right? Or we're going to have to make adjustments for me to close. So I don't mess anybody about. I'm very serious about the close. So if I've put in an offer, my intent is to close.
Is to close, to go forward. And just going back to the deal flow and working with brokers right now, as you said, like, to let them know as they send. And that's one thing that I've always made clear with them is, you can send me deals. If I'm not interested, I'll tell you, and I'll tell you why, so you know what to send me in the future. But the worst thing for them is to send stuff and then it goes in a black hole, and then they just don't know, and they follow up and you never give them an answer, and then they bother you. Just like, as you said, just be upfront. If you're not interested, just say so. It's fine.
Yeah, absolutely right. So that's a key component for sure. And you were talking more about going into 2024 as well. And I think it's worth talking about a variety of aspects here. One of the things that I've seen in the past, and I think a few people are starting to get bitten with this, is when we do an acquisition and we put a term loan of some form, right? So a 5-year term or a 10-year term on that commercial asset. You have to think of a way to deleverage that asset during the period of your holding period. A lot of people I saw, and still are trying to leverage to the max, right? And they're going to 85% LTV if they can possibly get it. Or with some construction loans with MLI Select, they're getting 95% loan to cost. So that's all fine, right? But you have to have a plan on your exit to deleverage. What that means is that if you're going in with an 85% loan to value on a refinance, and you're only doing, say, a 5-year term on that, you have to think about what's going to happen at the end of that 5 years. If you come out at that 5 years and you're still at 80 to 85% loan to value, but interest rates have gone up, as they have over the past year and a half, then you're in a situation where you are over leveraged. Your debt coverage ratio is not going to work. And therefore, the lender is going to say, not only are we not going to give you an equity takeout, but in order for us to renew this loan, you're going to have to come back into alignment with the debt coverage ratio. And that means you're going to have to put equity, money into that particular property and that asset to deleverage the loan in order for you to even get any form of a renewal. So, and a lot of people don't think about that, right? They just kind of say, I'm set for 5 years. Let's hope that the market does everything you want. And if it doesn't, then you're in a bad situation, potentially upside down on that particular deal. So we're certainly seeing that right now. I've talked to a couple of mortgage brokers who are starting to see that. And I've always preached that, deleveraging exercise anyway, but there's some people who haven't. And there are situations where lenders are saying, I don't care what the situation is, we're simply not renewing. You're going to have to go find a new lender.
Yeah.
But even of the ones that are renewing, they're going to want to see a debt coverage ratio that's back in alignment with what they need. And some people say, okay, well, yeah, but I've got CMHC insurance and I've got a COI and I'm going to be just fine. Well, no, if you take a look at that CMHC certificate, it tells you quite clearly what the minimum debt coverage ratio is.
Yeah.
And that certificate is only going to be valid so long as you can maintain that. And that may mean you have to put money back into the deal to deleverage. So as people think about that, and you may say, oh, well, yeah, but interest rates are going to be lower when I go out in 5 years. Yeah, maybe not.
Maybe not.
So assume it isn't, because it's a horrible place to be when you're over leveraged.
Yeah. And no one wants to, after 5 years, have to re-inject to stay financeable.
Yeah.
That's just a terrible situation to be in.
That's right. Exactly. And so to the point where if I have an asset which I think is reasonably stabilized and I want to leverage it high, and I don't see a reasonable way for me to deleverage within my comfort zone in 5 years, I'll take a 10-year term. From my perspective, it's pretty straightforward. 10 years, I know I have a plan that does that. And the other thing that we do that I think is really quite important for people to think through, especially if you've got multiple assets, is a discipline that we have is we, of course, monitor our operating plan. We do an annual operating plan at this time of year. And my younger daughter, who, as you know, is in our business, I've given her that task this year to update the operating plan.
What a good overview of the business she gets.
Absolutely.
That's the best thing.
Yeah. So she's putting the operating plan together. We then take the operating plan and we generate a cash flow plan for the next 12 months. And the other thing that we do is we put together a 5 and 10 year operating plan as well. So what that part is really more along the lines of when does the debt mature, right? What's our plan in terms of keeping it stable for renewal, so that there's a deleveraging plan that we have to take a look at. And if a particular asset isn't going to meet our objectives on the deleveraging plan, then we need to find other ways to generate new equity to be able to do an equity pay down if that's what it's going to take. So we look at the maturity of those loans, and we put in place plans so that when those renewals come up, we're in a relatively safe position.
Yeah. It makes me think, I was with a mortgage broker recently, and she was reminding us of the importance of staggering all the due dates and the maturities, so that at no point in your portfolio do you have 2 or 3 properties with mortgages coming due at the same time. Ideally, spread over the years, spread over the period of the year, and so on and so forth. Is that something that you look into? Or, it may be rare that you actually do 2 financing at the same time. So naturally, if you stick to a 5-year term, they're not going to come due at the same time. But is this something you look at in your operating plan?
I do to some degree. That's a form of dollar cost averaging, if you will, right? And a little bit of risk mitigation on that. So it means that, not everything is maturing at the same time, that you suddenly have to find a pile of cash and it buys you a little extra time. We do that to some extent. We don't overthink it. As it turns out, most of our mortgages mature over a distribution of time. But the key at the very root of it is making sure that you have a deleverage plan, right? So if you have a plan to deleverage on the maturity, the need to spread it out year over year is less, but it's not a bad idea to do that, right? It adds a little extra protection. It adds a little contingency so that if you have to quickly bail out one situation where you've made a mistake, then you've got time to readjust and get ready for the next set of maturities. Yeah. So, in that respect, I think it is a reasonable aspect of risk mitigation.
And I just want to clarify for all those who are listening, when you talk about deleveraging, you're talking about re-injecting more capital against a property to lower your debts, right? So
Not
you'll say, okay, once a year I'll go and inject an extra 50K. Like, how do you plan that?
No. So not, I mean, that's one way. Like if I don't have any other way, then I can do that. But I'll typically hold it as a reserve. I won't literally put it into the principal right away. And some loans, of course, won't allow you to do it anyway. But I'll hold it as a reserve if that's the case. But more what I'm looking at is where, deleveraging comes in two forms. One is, as you said, you could put cash or set aside cash to deleverage on the maturity. The other is that you can look at changing the net operating income. So if you do something, you increase expense reduction, then you're going to increase the value of the property, and that has the effect of deleveraging relative to that.
Yeah. Okay. Because I was thinking about it in our case, and there was one particular property where, I mean, we've been wanting to deleverage. We haven't injected anything into it in terms of the debt, but we've really been able to keep rents at market. And we were, I think we've increased about 10K in NOI over the last year, or maybe 16 months. And so it was a good surprise to see that it's turned out well, better than we expected.
Yeah. And that's the thing to take into account. As you know, I don't like paying down debt, unless I absolutely have to. I'd rather, and what I mean by that is I don't want to pay the principal portion of my debt, right? Because it gets trapped. I can't take it back out. If I put money in, I can't take it out until a refinance event occurs. So I would prefer that if I have a concern around the leverage aspect of it until I have a better plan, then all I do is I'd rather keep the money in my reserves so that I have access to that money for any other eventuality as well. So staying in control of your working capital at all times, to me, is absolutely paramount.
Okay. And so for 2024, the deleveraging plan is definitely a good option. And that, to me, that really means like stick to your operation. As you said, decrease expenses, increase revenue. You got to stay as close as possible to the market in terms of your rental income. What else would you advise people to do for 2024 to be successful? Like, to be one of my mottos is to really keep consolidating, get better and better, and focus on the overall operation. And I guess that feeds into revenue and expenses. Is there something else that you can think of that would be worth sharing?
Yeah. I mean, the consolidation piece, we'll just touch on that first, and then I'll go to another related item. So in terms of consolidation, I view that as something we should do each and every day anyway. So I don't know if it's necessarily consolidation, but we always want to continuously optimize the portfolio. We want to put focus on the operations, keep it relatively tight. And if anything, I've actually expanded my team over the past year and grew it. Our cash flow grew, I think it was year over year in 2023, our cash flow grew about 24%. So, which you don't hear every day.
No, that's good. And that's not just addition of properties. You've also optimized your currents.
Absolutely. Yeah. It's a combination of both. So we're constantly adding value to the properties that we have. There can be some acquisitions, and the acquisitions this year were a minor contribution to that cash flow, but a lot of it is in restructuring properties. Because remember, we're always doing repositioning work.
Yeah.
Right. So that, we're taking an asset that's not at highest and best use, and we're finding ways to get it to highest and best use, and we keep that going literally every single day.
Yeah.
So that makes a huge difference. And the other reason that we're in good shape is, going back to our earlier topic, is we manage our debt very, very carefully. So we don't take a cavalier attitude of, go variable, right, or have open rates, etc. A small percentage of our portfolio does have some variable component to it, because that's, depending on what you're actually working on, that makes sense. Yeah. But we view fixed rates as a way of, it's a type of insurance, if you will. It gives us predictability for a period of time. We know exactly what the impact of cash flow is going to be. And we know we have a a time frame in order to, as we talked about, deleverage the asset in terms of the next piece. So do I pay a premium on those fixed rates relative to variable rates? Sometimes, definitely not over the past 2 years. But before that, yeah, sure. It was a small spread, honestly, compared to what you were doing in variable. But to me, it was an insurance premium, and it results in absolutely predictable cash flow, because it's really important to me that I can pay our employees through that period of time. I don't want to have them stressing out over their jobs just because I made a mistake with respect to calling the shots on interest rates. So.
I was going to say, I'm so happy to hear you say that, because that's a conversation that I remember having 2 years ago and not anymore. And people telling me, no, Axel, if you look at a 40-year average, the variable always outperforms the fixed and this and that. It's like, yeah, but I want to sleep at night. And I invest long run, but I really just invest for 5-year terms. So I want predictability. I know exactly where I'm going to be. I've always gone fixed. And at the time, it was, we had some at 175. We had some other ones at, I think it was 235. And it's like, when rates are so low, you want to lock in because you want to protect against rates going up, not against going down. And then at the time, they couldn't go any lower. Why would you not lock in? Anyways, still to this day, I remember having heated conversations with other investors. And now they're the ones who say, oh my God, my mortgage payment, I can barely afford it. My cash flow is wiped out. Anyways, so stick to predictability.
Absolutely. And I'm making acquisitions right now, and I'm still doing some fixed term rates. I could go variable on them, but I'm looking at it saying, you know what, I may be paying a bit of a premium on this, but I know that business case, including the debt structure there, is going to give me predictable cash flow with upside. And later on in the future, it'll mature and I'll be deleveraged, and the cash flow will be even more improved. But I have well-defined cash flow coming into the acquisitions that we're doing. So the other aspect with 2024, right? Because you were asking me, what advice I'd give, and I was responding more to the advice you would give, which was just great advice. The other piece that I would look at is that too many people are looking at, and this may be in relation to what we were just talking about, too many people are looking at the opportunity of reduced interest rates, right, coming up. And they're banking on it. And they're saying, oh, interest rates are going to come down, mid-2024, which, by the way, a year ago, we heard mid-2023.
Or end of 2023, and look at us where we're now.
Yeah, now they're predicting mid-2024, and I think as we go into the year, it might be even later.
And seeing the economists' prediction, it was only like around 4 to 425 a year from now, so end of 2024. So even if there's a 25 basis points decrease, we're still just at 475. Yeah. It's not going to go down much next year.
No, it probably won't. And, one of the things that I always say is that as knowledgeable as I am, my ability to predict the future and the future economics is slightly better than random chance. So, because, macroeconomics is just incredibly unpredictable. I mean, could you have predicted the pandemic? Could you have predicted the Russian invasion into the Ukraine? Could you have predicted that Israel and Palestine would be at war? More specifically, Hamas and Israel would be at war right now. You could predict that it was going to happen at some point. You just couldn't predict when, right? And, with the pandemic, people were expecting it might happen, but was it, in 2020, or was it going to be in 2030?
Yeah. From an economic point of view, there was one thing that could kind of be imaginated, is that by injecting so much money in the system and not increasing output, inflation was definitely going to creep in. We just didn't know how much and when, because there's such a time lag. But we could expect prices to rise, just not to the level that it did, where we hit 7 to 8% of inflation.
That's right. And we have to remember, too, that while the Bank of Canada is, has been raising the overnight rate and doing quantitative tightening, nobody talks about the QT component, right? But that's been ongoing as well, which is what's affecting fixed rates and long-term yields. So that's while that's been going on, the federal government has been still running a rather large deficit. So it's kind of like having your foot on the gas and the brake at the same time. And then the external events that are happening outside of our borders are largely beyond control, or largely beyond our control. So the bottom line is that while I'm reasonably optimistic that there may be some tempering, particularly in the fixed rate side of things, and we go back to an inverted yield curve, there may be, some indication of some form of a recession as we go into 2024, which might cause the Bank of Canada to just kind of back off a little bit. We don't know how much, how deep. We don't know whether or not things could reverse because of some other issue that happens. So I never go into a year or go look forward with the expectation that we're going to have more favorable interest rates. I just assume that what we're dealing with now is the norm, that we might see some increases relative to this new norm. And if we go the other way, where we get some reduction in rates, that quite frankly is just gravy and upside, right? Yeah. So that's the way I look at it. Mm-hmm. So, but if we do, in fact, go into a little bit of a recession, aside from, interest rates, there's potential impacts to your revenue side, especially in the commercial piece of it, whether it's residential or pure commercial, right, is it can affect the ability for your tenants to pay, right? And that can affect revenue, and that'll perhaps offset any gains you might have in interest. So I take the attitude that this is what normal looks like again. And prior to 2008, this is what it looked like, right? Yeah. For those of us that have been investing.
That remember.
Yeah, exactly. Like 2008 to beginning of 2022 were truly unusual times, right?
And a very long cycle, because it was more like 12 years, almost 15, 12 years, whereas usually it's more like 8.
Yeah, so. Absolutely. And we also have to remember that the Bank of Canada needed this room as well. So they were increasing, of course, to moderate inflation, but they need enough. They need to get interest rates at a sustained level where people accept them as normal again, so that if they do have a recession, they have room to decrease the rates in order to be able to create the stimulus that they want. For the past, roughly 15 years, right, or the 13 years before the last 2 years, they were kind of stuck. There was no room to move down if there was.
They were so low.
Mm-hmm. Exactly. So that's a key thing. And the other thing that I'm reminded of all the time is people like to listen to Benjamin Tull, who's with CIBC, and Ben gives a lot of sage advice. He's thinking we're actually, tipping into some sort of a recession. The Bank of Canada may reduce their overnight rates a bit. And we're certainly seeing the 5-year yield come down a little bit. As well. But I'm still, reminiscent of what he said June of this year when I was at the CFAA conference, the Canadian Federation of Apartment Associations conference in Halifax. And he said, the Bank of Canada hates inflation more than it hates a recession.
Exactly. Well, it's perfect. It gives the sense of the priority.
Yes. Yeah, that's exactly it. So if there's and they really don't care. The Bank of Canada is relatively insensitive to the impact it has to people on an everyday basis. Mm-hmm. What they do to increase rates necessarily causes pain, and they know it, right? And they don't make any excuses about it. It's what they need to do to make sure that inflation doesn't create even more pain. Mm-hmm. Because we have to recognize that in an inflationary environment, people on relatively fixed incomes or on salary, and they don't hold assets or debt, are the most negatively impacted in that environment. And those of us that are holding debt, it's actually a boon, right? And people worry about, oh my God, inflation, when I've got debt, my interest rates, and you and I talked about ways to mitigate that risk. But the thing that is absolutely happening is that your debt is getting reduced as a result of inflation.
Naturally.
That's right. Mm-hmm. And it becomes part of your, deleveraging, if you will, right? Or deleveraging impact. But fundamentally, I like to see inflation take care of my debt.
Yeah, but we can't count on that too much. And as you said, like also for the vast majority of Canadians who who don't hold assets, which is really a vast majority, that's a very painful situation. So for the Bank of Canada to say that they hate inflation more than recession is not too surprising, because their objective is the long-term economic stability, not a 3-year period.
That's correct. That's absolutely correct. So, with all that in context, as we go into 2024 and think about 2025, there's lots of reasons why interest rates should moderate, maybe even, as you said, go down a smidgen. We can see that with quantitative tightening, the Bank of Canada has been doing a really good job of offloading all those bonds that they bought through the quantitative easing period during the pandemic. And based on the volume that they're sending out to the bond market right now, my guess is that they'll be complete on quantitative tightening with respect to those bonds, right, that they bought through the pandemic by the end of 2024. And if they're not selling those bonds back into the market, then in theory in 2025, we're going to see less pressure on the longer term bonds unless they decide to do something else. So there's a lot of reasons why interest rates may go down. I just don't think anybody should count on it. And therefore, when you're looking at your debt management, when you're looking at potential recession and how it might impact your revenue, if you're looking at how it might affect valuation of your property, any of these kinds of things, what we need to do and what we should do every year, in addition to what I was saying in terms of our operating plan, is we have a risk management plan. So anything you think you're worried about, write it down. Okay, then figure out what's the likely severity or impact of that happening, and what's the probability of that happening. And then if it's severe and highly probable, you're going to want to put a contingency plan in place. You just want to make sure that you know how you're going to exit effectively. So you don't want to be in a situation of hoping everything is going to be okay, and hoping interest rates are going to come down, and hoping your revenue is going to be, management by hope is never proven to be successful.
No, and that's proper planning. If you plan properly, you'll be okay. If you fail to plan, you plan to fail.
That's pretty much it. And contingency and risk management planning is essential, absolutely essential to this. So I do highly recommend to people that are listening is literally think about the risks associated with what you have, be it personal, be it your business assets, be it your business. Think about the things that are keeping you up at night. So if you wake up at 3 a.m. because you're worried about something, write it down. Okay, next morning, think about it. Think about the likelihood of it happening. What would be the impact if it happens? And then determine what's going to be your plan of action if that risk actually manifests.
See, I love this advice. And for those who are listening, you hear what Christian said. If you wake up at night and something's bothering you, and that's, I guess, for your real estate portfolio and other, write it down and then deal with it in the morning and think of what's the risk, what's the impact, and what plan can you put in place. That's a really good one, because sometimes some stuff like that happens and we fail to take action. We're just like, oh, it was just a bad dream. Yeah, well, it woke you up. Maybe you should take it seriously. Like it's called the nightmare for a reason.
And we all go through it. It doesn't matter how experienced you are, right? Like I certainly I worry enough. Now, it doesn't prevent me from taking action. I always take action. I know that I can run cleanup if I have to. But as I take that action, right, I think about the potential risks, and I don't let the risks hold me back. I just write them down and I figure out how am I going to manage those specific risks if they do actually manifest. And that allows me to not worry anymore and move forward to get things done. So, as we started off at the beginning of this discussion, this is a great time to buy, right? It's not without risk, but right, I know how to manage those risks and I take them into account. And I'm getting deals now that, quite frankly, 2 years ago, there was no way I was going to get these kinds of deals.
Well, it's also the negotiating leverage that you have with sellers who they've adjusted their expectation in terms of price, but you can just say, hey, look around. Do you see anyone else making you offers? So
yep,
if you're cash trapped, you know what to do.
Yep. And it may just take a bit more time. That's the thing. You got to be patient with the seller, because the seller is mentally stuck to where they think they need to be. And time and persistence in the discussion is how you'll get them around to the right frame of thinking.
Yeah. Yeah.
And, I've had deals, even in the past, in relatively good periods, I've had deals that have taken like 9 months to mature, right? And before the seller finally came around to understanding why I was saying that my price was more fair.
Yeah. It's patience. It's like everything else in real estate. Hey, Christian, as we're getting towards the end here, if people want to find out more about you and get in touch, what's the best way to do so?
Oh, I'm all over social media. I always like to help people out. So if you find Christian Szpilfogel on Facebook, LinkedIn, Instagram, those are probably the primary places that you'll find me there. I have a website, aliferous.ca, where we have a lot of information for investors. It's free for you to use. These are all solid resources. They're not fluffy resources. And the other thing too, especially for people in West Quebec and Montreal, you're very close to Ottawa, and I'm on the board of the Ottawa Real Estate Investors Organization, OREIO.org. We're a not-for-profit club. Meaning that while we have dues, the dues are literally just to cover the venue that we have and a variety of small operating expenses. All the board is volunteers, and it's really investors to help investors. So we invite our friends from Quebec to come over to Ottawa and benefit from some amazing speakers that we have there.
Yeah.
Second Wednesday of every month.
And I've attended some of those events, and indeed they're very well organized, and you have very good guests, and it's always been a good learning experience and good networking opportunity. So I really encourage everyone to go and join OREIO. Yeah. Christian, it's been a real pleasure. Thank you for this half macroeconomics and how deleveraging reminder. I think that's my biggest takeaway today. And we will talk again soon. And it's always a pleasure to have you on the show.
Thank you very much for having me, Axel. I look forward to the next time.
Sounds good. Thank you. And for all those who are listening, as usual, research your market, educate yourself, most importantly, and then make some offers when you're ready. Thank you very much. And I'll talk to you next week. Bye-bye.